Hi, I'm Tom Lydon, editor of ETF Trends, and welcome back to the 2013 ETF Virtual Summit. It's a pleasure to be here with Rob Arnott, who's the founder and chairman of Research Affiliates. Rob, thanks so much for being here today.
It's a privilege.
Appreciate it.
Thank you.
Rob, I tell you, your outlook on the market seemed a little bit gloomy, and you've got a report and all the discussions about this 3D hurricane. Can you tell us a little bit about it?
Sure. Actually, these are some pretty daunting headwinds coming our way. I should caution the folks who are watching this to please don't blame the messenger, and also to recognize that there's always something interesting to invest in. And so when I talk about a difficult environment, I'm not talking about an environment in which it's impossible to do reasonably well on our investments. What are the headwinds? Deficit, debt, and demography. The deficit, officially, we had $1 trillion deficit last year. That's pretty horrific.
Right.
Unfortunately, it's complete fiction. If you add in off-balance sheet spending, if you add in net increases to unfunded Social Security and Medicare obligations, if you add in the GSEs, Fannie Mae, Freddie Mac, and the rest of that alphabet soup, under generally accepted accounting principles, the deficit last year was $6.9 trillion in a $16 trillion economy.
Wow.
Those aren't my numbers. Those are Geithner's numbers.
Okay.
They were published to zero fanfare, of course, and watch the media studiously ignore the number.
So what does that all mean? I mean, it sounds very gloomy as far as your outlook.
The deficits are daunting. What it means is that we're addicted to debt-financed consumption. A family that measures its success based on how much they can spend. Call it GFP, gross family product, where gross family product is how much were you able to spend last year.
Right, right.
Boy, let's go out and buy a car we can't afford, buy a house we can't afford, and until the house is foreclosed and the car is repossessed, our quality of living is just marvelous.
Yeah, right.
It feels great. Debt-financed consumption feels just as good as spending money that we already have and have set aside. But it's not prosperity, whether it's a family or a nation. If the deficit is much bigger than it's advertised to be, the debt is also. And indeed it is. The national debt crossed 100% of GDP last February. But again, that's fiction. If you add in GSEs, if you add in unfunded Social Security, Medicare, and Medicaid, what we're looking at as a true national debt is just shy of 600% of GDP. If you owe 6 times your national income, it's unsustainable. You cannot possibly honor those obligations. As an investor, what I like to do is to focus on inevitabilities.
Okay.
What can't happen won't happen, what must happen will happen. And if instead of debating whether these things will or won't happen, if I devote time to thinking about what's the path of least resistance for getting from point A to point B, then that can make a difference in terms of investment strategy and in terms of finding ways to weather this storm.
The government, and one of the fallouts obviously would be inflation. I know you're concerned about inflation, but the government said we really don't have that much inflation right now. Is that the truth?
Short answer is no. It's very interesting. Inflation peaked at a little over 14% in 1981. Using today's methodology for calculating CPI, that inflation would have been less than 10. So we've changed our method. How many people seeing this conversation viscerally, truly believe that their personal inflation rate was less than 2% in the last year? So inflation is seriously understated. This creates an illusion of growth because GDP is measured after subtracting calculated CPI, actually GDP deflator, not using real numbers.
Right.
All of this runs headlong into the third D, which is demography. How many media reports did we see doing a careful analysis of the fact that in 2012, for the first time in U.S. history, the population of senior citizens rose faster than the population of working-age adults. I didn't see a single such report, and I was looking for them. In fact, I was encouraging media to come forward and
they
do
didn't
that.
bite.
No.
No.
That 1-to-1 ratio of new workers to new retirees goes to 10-to-1 in 10 years, the wrong direction. 10 new senior citizens for each new working-age person. These are the 3D headwinds: deficit, debt, and demography. And what we're experiencing right now, and what we're seeing played out in Washington and in Sacramento and in academia, academic debates, Keynesians versus the Austrian school. What we're seeing played out in all of this is early gusts of the 3D hurricane. Japan is experiencing some of the full brunt of it now. Europe is closer to the hurricane than we are. But what we've seen in the last few years in the Sturm und Drang going on in Washington is really just early gusts. This is going to be an interesting storm.
So when it hits, what's it going to look like?
Well, firstly, forward-looking rates of return for investors aren't what most investors would like to expect. Bonds yield 2%. The fact that they've delivered 9% a year for the last 30 years is irrelevant. The yield is 2. That's what you should expect. Stocks have delivered 12% a year for the last 30 years, but that's also irrelevant. The yield is 2. Long-term historical growth over and above inflation is a little over 1%. And inflation expectations baked into the break-even inflation rate for tips is between 2 and 2.5. That gets us somewhere in the 5 to 6% range as a reasonable expectation for stocks. So one of the things that is urgently needed is for people to ratchet down their expectations. Low returns are not dangerous. Low returns in a context of expecting high returns, planning for high returns, saving comparatively little because you expect the markets to do your savings for you, that's dangerous. Another element of the 3D hurricane that is important is to ratchet down our growth expectations. We've seen 2.5% real GDP growth over the last 50 years. That's nice. That's with a demographic tailwind, though.
Yeah.
We had a large roster of working-age adults over the last 60 years with fewer children to support than ever before, and with not a whole lot of seniors to support. The latter part is changing, and changing fast. The proportion of the population that's senior citizens, 60 years ago it was 9% of the population, now it's 12. It goes to 20% in the next 20 years. Wow. So we switch from demographic tailwinds to demographic headwinds. GDP growth is a function of workforce growth plus productivity growth. The workforce is going to be growing about 1% a year slower than in the past. There goes 1% of GDP growth. The productivity growth will also slow. Those of us in our 40s and 50s are, unless we're manual laborers, are at our peak productivity.
Right.
We're a lot more productive than we were 20 years ago. But our productivity growth is slower. Productivity growth is a dynamic associated with young adults. High productivity that's relatively static and not growing very fast is a characteristic of mature adults in their 40s and 50s. And so when we look at the composition of the labor force, we're looking at a composition that says, oh, these people have already reached peak productivity. Peak productivity by definition means you're done rising in productivity and getting ready to settle into a decline in productivity in coming years. And that means that piece of GDP growth also has to be ratcheted down. So I think the new normal for GDP growth is likely to be more like 1% rather than 2.5 to 3. Again, it's not bad news. It's still growth.
Right, but we have to...
The expectations gap is dangerous.
Yeah, absolutely. So all this translate into you got to have a strategy, and you pioneered fundamental indexing. So please take a minute and talk about the fundamental indexing approach and how that can address this coming hurricane?
Sure. Firstly, for those who are viewing our conversation who aren't familiar with fundamental index, it's a really simple idea. Why on earth should we weight companies in an index according to their market value, their market capitalization? That's what most indexes do. There's nothing wrong with that. If you want an index that mirrors the look and composition of the stock market, that's how you get it, by cap weighting. Cap weighting does have an Achilles heel. It means that most of our money goes into the companies that are highest priced, highest valuation multiples, most popular, most beloved, the companies with great growth expectations, the safe havens. Why should we earn a full equity risk premium for investing in safe havens and growth? What about choosing a different way to index? Why not index companies based on how big their business is, and to use the business scale as an anchor to contra-trade against the market's constantly changing expectations, speculations, fads, bubbles, crashes. Now, the market takes some companies and says, these companies have wonderful prospects. We love them. We want them in our portfolio. We'll pay a premium. These companies are facing challenges. We don't want them in our portfolio. We'll price them at a deep discount. Fundamental index says, oh, thank you for these gains. Now let me reweight those companies back to their economic footprint. And for these, oh, thank you for these low prices. Let me reweight those up to their economic footprint. In so doing, it creates a value tilt relative to the market, but it's a dynamic value tilt. You're contra-trading against the market's constantly changing views on what deserves a premium or discount and how large a premium or discount it should have. It turns that volatility into incremental return.
So I've got a couple questions. That systematic index, and is that adjusted on an annualized basis, is that right?
There's two variants. There's the FTSE RAFI, which is rebalanced annually in March.
Okay.
There's the Russell Fundamental Index, which is rebalanced, partial rebalance quarterly. It has the same effect as an annual rebalance, but it smooths a little bit of the transition from one weight to another by moving 1/4 of the way each quarter towards the target weights. So they're both very effective. It turns out if you rebalance too often, all you're doing is enriching the brokers.
Okay.
And if you do it too rarely, it turns out a sweet spot is about once a year.
Okay.
And so the rebalancing introduces low turnover, introduces low trading costs, introduces a portfolio that's tilted towards big companies. Well, those are the liquid, easily traded companies. So the liquidity is marvelous, the capacity is marvelous, the implementation shortfall is tiny because the turnover is so low. It's a powerful way to handle your investments.
Absolutely. So you now, with these index structures, and now that you've built up some momentum and track record, you've had a decent partnership with the folks at Invesco PowerShares.
It's been a wonderful partnership.
So tell us a little about that, because they, in fact, now have had indexes, or use your indexes and put ETFs around them. So they're available for advisors.
They were launched, the indexes were launched by FTSE back in November of '05. PowerShares, Invesco PowerShares, launched the FTSE RAFI US 1000, the 1,000 largest businesses in the U.S., 3 weeks after the indexes were launched.
Great.
So they launched in December of '05. They've outperformed the S&P, and they've outperformed cap-weighted ETFs with some regularity, and on a cumulative basis, they've outperformed in an environment in which value has underperformed. So, how do investors deal with this 3D hurricane? Firstly, broaden your horizons. Don't limit yourself just to domestic and mainstream stocks and bonds, the classic two-pillar investments. Mm-hmm. Look outside of the norm. Look to alternative asset classes. Look outside of the U.S. Emerging markets have rapid economic growth relative to us, and yet they have higher dividend yields.
Mm-hmm. Yes.
So that our portfolios can work for us in the long run. and deliver 1 or 2 or 3% more than the broad market's performance. If the markets are priced to give us 2 to 4% for bonds and 4 to 6% for stocks, classic balanced portfolio is going to give us 4%. That's not very good. It's a heck of a lot better than what the Fed pays right now, but it's still not very good. So if we can take that 4% and boost it by a couple of percent by using tools like fundamental index, if we can be tactical and move money into markets that are out of favor and unloved, then we have an opportunity to boost our returns to maybe the 6 to 8% range. That doesn't sound like a huge number. Look back on that number 10 or 20 years from now, it'll turn out to have been a huge number.
Rob, thanks so much for your time today. I appreciate it. I'm going to go out and get a slicker and a rain hat and get prepared like hopefully everybody else.
The thing is to get prepared. A lot of folks hear this message and they think, oh, this is just a lot of doom and gloom. No, it's a wake-up call. It's a chance to get our acts in order, save more, spend less, plan on working a couple of years longer. That's not an awful picture.
No.
And if people save more, spend less, and plan on working a couple of years longer, they're going to be fine. The people who expect everything to work just according to what Washington tells us it's going to look like, they're in for trouble.
Well, thanks. Thanks again, and we appreciate your time and guidance.
Thank you.
Again, this is Tom Lydon, editor of ETF Trends, and we hope you enjoy the rest of the ETF Summit. Thanks, Rob.